This is the Collecting Real Estate Podcast. I'm your host, Stephen Purse, here with your co-host, Bill Hamill.
I'm somewhat more comfortable collecting real estate than I am collecting other stuff.
This is the Collecting Real Estate Podcast. I'm your host, Stephen Purse, here with your co-host, Bill Hamill. This morning, we interviewed Joe Sullivan from Sharpline Equity. Joe has seen amazing progress in the last 3 to 4 years, and he contributes it mostly to surrounding himself with successful people. Bill, what'd you think?
Absolutely. Joe has really grown dramatically, going from 2 years ago with single families, two families, mowing grass, and now he's going to own over 1,000 units by mid 2022. And, it's amazing. I think anybody that, is in this business and is looking to grow, they can only dream of getting to the point where he has.
There are so many people in this business that are where he was 3 years ago, buying ones and twos, riding around with a lawnmower in the back of their car, and they hear 1,000 units under management, and it doesn't seem realistic. But Joe tells you how to get it done today.
Well, you get it done by being part of an all-star team, and that's what Sharpline is.
Surround yourself with excellent people.
So,
Joe Sullivan, thank you for being here this morning. I've heard lots of great things about your success in the multifamily space. Really excited to hear some more. Tell us first, how did you get into real estate? What's your real estate background?
I started investing on my own with like single family and duplexes about 3 years ago. It might be getting closer to 4 years ago. Um, Me and my wife, and in the Kansas City area, more specifically, like we talked about earlier, Stephen, Lawrence, Kansas is it's actually where we really started. Um, and then kind of the story is just ran into um, a lot of struggles with trying to do everything. I was doing what maintenance I could. I was mowing the lawns at times. You name it. I was doing all the wrong things. Knew I wanted to continue doing it and try to scale. Um, so I needed to try to figure out a more efficient and better way to scale in real estate. And just so started just mass consuming books and podcasts and just whatever I can get my hands on. Um, and Came across a few different education platforms. There's several out there. Really resonated with the Jake and Gino group, which I joined 2 years ago, a little over 2 years ago. Um, Got hooked up in there, really dove in head first because I knew I wanted to do multifamily, wanted to do it at a larger scale, and knew I needed to leverage other people. So got in there I've met all of my partners and a lot of our investors now that we have through the community. It's an amazing community. It's really changed the trajectory of my real estate investing and frankly, my family's path in our life. So fast forward to today, we're about 750 units. I don't know the exact number, and then assets 750 units assets under management, and then we have another about 300 under contract. So it's been once we got the first the first larger deal, which was a 44 unit, that took almost a year to get under my belt after I joined the education group. Once I did that, it was really kind of a snowball effect. And now it's we're kind of off to the races.
it's great to have you this morning, Joe. I've been watching you since I joined that same mentorship group you did. And after joining Jake and Gino, looking back now, did you ever visualize or think that you would be in this position where I'm doing your math here you're going to have over 1,000 units by, I don't know, mid 2022.
Yeah, it should be right around 1,000, yeah, give or take. But I know I never would have even dreamt that I would have thought that 3 or 4 years ago I would have thought that would take me my lifetime, to accumulate that many units. But that's the amazing part of getting educated and just really having incredible partners and mentors. Surrounding yourself with people that are doing things that you want to, who've already accomplished what you want to accomplish.
I think there's a lot of listeners out there who are in similar positions to where you were when you first started. They're starting with the single families, the 2 units, maybe in an area they know, like the college they went to, similar to how you started. And then for them to hear that, 3, 4 years later, you have almost 1,000 units under management, it's probably hard to believe. What would you tell someone who's still in that position?
I would say that you need to, if you really want to scale, and if you're determined to do it, is to really to get educated, and surround yourself like you really are the sum of the five people you spend the most time with. I've done that's something I've done a really good job with. Is I'm I'm probably I'm the junior guy in the teams I'm with. So I'm the newbie. I'm soaking up all their experience. I think that's the key. I mean, just you got to get educated and you got to surround yourself with great people.
And you're with two great groups, the teams that you have been able to get involved with. And as a lot of us know, it's a complementary skill set from partner to partner. So you had to add serious value to each one of these partnerships. What is the area of expertise for you?
Yeah, it's a really good point. When I first started and really wanting to get into multifamily away from like the singles and the duplexes, like Steven mentioned, my mentor, Marco Barbero, he really pushed me to lean into my strength, like you said, Bill. He helped. He actually, frankly, he helped me identify that. And I live in a good cash flow market in the Midwest. I live in Kansas City, and he was just, his point was you need to lean into finding deals and being the local relationship and people call it boots on the ground. So that's where I could add value. So I did. I that's what I focused all my time on finding deals. Found a few off market, which have been really great deals. Um, and just being the local connection for people who live out of state. All my partners now are out of state. They're in New York or Florida, or the Southeast, somewhere in the Southeast. So I'm the connection to them here locally, and that's the value I added. And obviously they add a different type of value with experience. They help with capital a lot, those types of things.
A lot of value having boots on the ground. If you want to get linked up with those large multifamily teams, the easiest way to get into it is to either find the deals or raise the capital. It seems like you've gotten really good at finding the deals. Can you get a little bit more specific on what you actually do to find these assets that are ready for sale?
Of course, yeah, yeah. That was my kind of my niche to get into, with the Sharpline Group at first, and a lot of it is cold calling, mainly cold calling, and then networking. I've lived in Kansas City most of my life, so I know a lot of people. So it's just letting people know what I'm doing and what I'm trying to accomplish. And one of the deals came from networking. It was a great deal. We're actually going to refinance it. Knock on wood, we should be refinancing it next week and be able to pull all of our capital out after just over a year. That was an off-market deal. A friend of mine, his uh, his friend's uncle owned it, and it was just a networking thing, just letting people know what I was doing, and then a couple others have been actual cold calling.
No, that's great. And I've seen you guys get into different markets throughout the country. What has your deal criteria been, and how are you selecting different markets?
Yeah, so we look for we like cash flow markets, um, and markets with good population growth and good job diversification. So those are some some key metrics for us. We're in Kansas City area, so that's Kansas and Missouri, and then we're in Oklahoma City, and then we're in Columbus, Ohio.
I've heard a lot of great things about the Kansas City market. I need to spend some more time researching it. My first job, I went through about 2 months of sales training, and this was rigorous cold call training day in, day out. So whenever I get another dialer on the podcast, I like to hear more about their tips, their methods. When you're calling a property owner, how do you start that conversation? Is there any secret sauce that you have, or are you just treating it like calling your old buddy from high school?
Yeah, I mean, I try to break it down. The first sentence is, "Hey, Stephen, this is Joe with Sharpline Equity." So if you it kind of catches them off guard and usually puts them on pause if you use their first name,
Hmm.
and they tend to listen longer, and you don't get a click. You don't get to hang up as fast. So the key is to keep them on the phone, as you know, Stephen, and really my ultimate goal is to keep them on and keep them talking, because a lot of real estate investors and owners are proud of what they own and what they do. So if you get them going, sometimes you'll be able to hear their life story, which is great. And then the end goal is really for me is to meet with them, try to get face to face. That's really I mean, there's a lot in between there, but that's kind of the high level of what I'm trying to accomplish is keep them on the phone as long as possible, get them talking about themselves and their property, and then figure out a way to have some common ground and get a face to face.
No, it's great knowing that your boots on the ground in your local area and you've had success there. When you're doing direct to seller in some of these other markets and you develop that rapport and you're able to get an owner's attention, but it is in another state, what does that look like? Because the next step is, of course, walking the property, meeting the owner, taking that next step, looking to get to that goal of purchasing the property. Are you jumping on planes to go to these properties? Are there other partners that take care of that? You hand off the baton. What does that look like?
Yeah, that's a good question. I'll like for Oklahoma, I drove down the same day when I got a hold of somebody. So yeah, I mean, sometimes you just have to do what other people aren't willing to do, which is take a 5 hour drive. Didn't get the deal, but it had promise. We almost got it. And yeah, our partners also contribute with that. Well, Columbus is too far of a day drive, so that'd be a flight.
Now, someone that's professionally networking and cold calling and really outreaching full time, I'm sure you have a lot of moving parts, contacts that need to be followed up with. How are you keeping track of everything? Because there's nothing worse than getting a lead and then letting that lead slip through the cracks because you had 10 other things going on and you forgot about it. So, is there any software you're using or any systems that you're following to keep track of all these leads and potential deals?
Yeah, we it's not nothing super sophisticated. We use Monday.com. I know some people use Asana. There's others as well. We like Monday. I like frankly, I'm a visual person, and you can color code it. So I like to be able to modify the color coding on Monday. Um, so yeah, that's our system we use, our CRM we use.
So, that's acting as a CRM and a task organizer.
Yeah, it's more of a task organizer, but yeah.
Okay.
Yeah, so you're able to operate the entire team through those platforms. So you're communicating with each other. They're seeing lead generation, what has been done, so everyone's on the same page at all times.
Yeah, we'll move. There's the lead funnel, and we'll move it through the different steps in the lead funnel on the different boards on Monday, and everybody has access. We use I don't know why I can't think of it right now. Our daily communication Slack. We use Slack for our messaging throughout the day. That way we don't have to call or text or email constantly. It's just it's a different version of an IM. And then we use Slight. That's for our SOPs, because we are building out a management company on our new properties we acquire in the Midwest. So we're on property number 2 with Sharpline Communities. So it's building another business on top of the syndications.
Talking about building another business on top of the syndications, there's a lot going on. We talk a lot about staying in your lane, because if you get distracted, it's hard to make progress in any one area when you're trying to swim down 3 lanes at the same time. Knowing you have so much going on with Sharpline Equity, are you still actively looking to add any ones and twos to your original portfolio, or have you kind of put that on the sideline?
Yeah, I won't be doing any singles in the future. Yeah, it'll be solely focused on multifamily. There'll be no the singles actually, they just suck a lot of my time up. So that there'll be no more of
Yeah,
those.
single families. Next thing you know, he's going back to having his lawnmower hanging out of his car trunk, and it's just a complete distraction. One roof instead of, I saw that you guys and just recently, where you're taking a large apartment complex where you're actually raising the roof, putting a different roof on just for a cosmetic look as a value add on that deal. Tell us about that mindset on, really transforming the entire look of that property, because that's a huge capex item.
Yeah, I'm very excited about that project. It's hit some delays because of supply chain issues. We were doing about $2 million in capex on it. Um, and some of the TPO roof, the roofing, the material is on delay. I'm sure if you're involved in any kind of like construction right now, everybody can kind of feel the same pain. Um, but that property is truly in like a B plus area, great area, right next to a really nice college, a lot of retail. But it's definitely a C property. The condition when we bought it was very distressed or distressed. And we just had the vision that this property here, this kind of eyesore in the neighborhood, if we can figure out a way to flip it, frankly, into and really turn it into a B or B plus property, that it could just take off. And so it has mansard roofs. For those, I'm sure those are familiar with that. It was built in the 70s. So we're actually ripping off the mansard roofs. The side, it's basically like siding, and replacing it with like hardy board plank, painting that, and then it has brick on the bottom, and we're painting the brick. And actually the transformation from what it looked like before to what it looks like now, just on the first building that we've done, is it's actually incredible. I'm very, very pleasantly surprised that it looks pretty darn close to the rendering that we hired somebody to do for us.
Value add multifamily. That's what we all love, right? you
Yeah, I mean, it's really we really believe on outside in approach. So, like, especially if you're trying to turn C class tenant base to B and increase rents, you want the first impression when people pull into the parking lot or drive by. You want them to get out and tour the property. In some cases, if they show up and they see a distressed asset, some people will just turn around, and you won't even get them into the unit to sell them on the property.
I've heard that. outside in approach. And it might have been another Sharpline member on this podcast. I'm not sure, but I definitely agree with it. I like that approach of dealing with the outside. You're talking about bricks and paint, and I'm getting excited here on a Friday morning. This is the stuff that we love. So if I'm a potential investor and I'm calling you, I'm saying, Joe, I want to do a deal with you. I don't want anything to do with the real estate, but I want to be a passive investor. What kind of returns can I expect on your next deal?
Yeah, I mean, most of ours, each deal is a little different, but most of them are seven pref with a 15 IRR. Um, that's generally. I mean, we have a little bit some that are better and some that are a little bit. It just depends on the the asset class. Like we bought some new construction, and the pref on that's a little bit lower. It's more stabilized. And then we've had some of these that we were describing, heavier lifts that has a lot bigger upside. But like year one, there's not much cash flow year one. But then on the backside, when we do refi it or sale someday, that's where the big appreciation pops
Yeah, I
are.
know that you guys have done different not at different asset classes, but different risk profiles, I guess you can say, where you had the one in Pennsylvania seemed to be more of a finished product that to an investor, the risk profile is a little less, where when you're turning a B plus location, tearing off those mansard roofs that to the audience, it's like an ugly mushroom cap type look to it. But seriously, making a huge capex addition, and naturally, as you just said, has a higher risk profile. You're investing. I think you said $2 million. So talk about that. Do you have different investors who have different appetites for these two different assets?
Yeah, most definitely. Yeah, there's some people who invest with us on every deal. We have that group without question. They're just going to invest whatever their typical investment is. But like that deal, the heavy lift deal, it takes a certain kind of investor. I think actually I would say that it probably takes somebody who has some like actual operational experience, who has done something similar, maybe like somebody who's been in flips or just really understands uh, and can see the vision, because your typical the limited partner who is never done real estate on their own, it's kind of a tough one to swallow, because it is a lot of work, and there is. I mean, you're probably not going to see a distribution for the first year, give or take, with a deal like that.
Sticking to the topic of potential investors, are you currently raising with accredited or non accredited investors?
We do a 506B investment, so it's friends and family. So we are allowed accredited investors, but it's not a we don't advertise
Yep.
for our
Do you
deals.
think you'll transition into that larger scale 506C advertising for deals in the future?
We don't have any intention of doing that. We've talked about it quite a bit. We haven't had any need to yet. The the network with our team is pretty strong. There's a lot of friends and family that like the deals, and it's still growing. So um, the biggest reason is for I'll give you an example. I have some family that wouldn't qualify as an accredited investor, and this is for me personally. And if we did a deal in the future that's a great deal, and we did 506C, which for accredited investors only, I wouldn't be allowed to have for example, my uncle or aunt or somebody like that invest in an amazing deal, and that'd be a tough pill to swallow for
Seems to be
me.
working well.
No, and why bother if you guys are over raising on every deal? you're able to do 506B, where you're able to just get sophisticated investors like friends and family, but you can also utilize the accredited investors also. It's just all about having that pre-existing relationship. And if you guys keep rolling along over raising on every deal, why do something any differently? I know one thing that you had mentioned that you are doing differently is starting to self manage. Tell us the mindset of getting into that, because property management is an entire different line item on that budget, takes a lot of focus, a lot of time. How did you guys make that decision?
Yeah, that decision was made um, it was actually made. We were in a tough situation on a property, um, and we had to make a decision to let go of our property management company. And kind of out of necessity, we took it over, and found a lot of leakage from the previous property management company. And really, the NOI has gone through the roof since we've done that. And the bit I'd say the word would be control. Like, we have ultimate control over the assets now, as we self manage. We do have some good third party property management companies we work with in different markets. So uh, I don't want to completely like say that that's you know not something we would consider. Um, but we love to have the control. We know all the money coming in, all the money going out. We know where it's going. Just as far even like going down into the details of what it costs to turn a unit, on paint. We know actually what the painter is charging. In the past, there was a little bit of confusion or misleading at times from some different groups. So um, yeah, it's really just about control. We have being fully integrated. You control the whole thing.
Tell me about that leakage. That's an interesting way to put it. So, what's the before and after result from having that leakage to self managing?
I'll tell you very specifically. We were our income on a property was 45,000 a month, and then fast forward 6 months after we started self managing, we are now at 59,000. So we have almost added 15,000 in income, um, because we have control. Expense side was also pretty significant. I don't know have the numbers in front of me exactly, but it was about 5,000 a month in expenses that we're saving. So you do the math on a 20k a month, um, improvement on your NOI. It's I think we added a couple $1 million in value in about 6 months to it's a 64 unit property.
It's a significant difference, and
Mhm.
being able to manage it, like you said, have that control and see every number coming in and going out. But also doing it in house requires more manpower, more time from Sharpline employees. I'm curious what a company that's rapidly growing and continues to plan to grow, what that looks like from an organizational standpoint. Is Sharpline currently hiring employees, or what does the company as a whole look like right now?
We are hiring. We hired. I think her title was she's basically like a project manager. We hired her at the end of last year, because we were doing a lot of deals and just transactions. It was just there's a lot of red tape, a lot of coordinating that we needed help with. So we hired her, and then we hired a property manager at one of our properties a few months ago. We just hired another one for the new property we acquired, and then we're hiring a regional manager, and then we have another property we're closing in about a month, and we have to hire 3 or 4 more people there. So we are in growth mode, and we're hiring we almost can't keep up with the hiring.
Hiring,
So
hiring. Absolutely. And what does that sound like when you guys are talking? I know that you're at 750. You're going to be up to 1,000. Are you guys just trying to be proactive on the hiring, where it's, hey, we may not need it immediately, but in a year and a half, we certainly will. So is it the mindset of, hey, let's not wait too long before we're a little bit bogged down. Let's take care of it now so we're set up in a year or two.
yeah, we are over hiring. To your point, we're hiring a regional manager, and we don't. Frankly, if we stayed stagnant, we wouldn't need a regional manager. But we're hiring for the future, the growth of the company. Um, and yeah, we're and also we also believe in we've done a lot of market analysis on salaries and wages, and we're overpaying too. In a good way. Just we want to be 10-20% over the market, um, and be a great place to work. We don't want to fight with pinching pennies on wages with our employees. When we want them to be excited to come to work and be compensated well.
Creating that culture. Are you having any struggles on that maintenance side? I think that it's pretty much common knowledge with so many people in this business, the construction business in general, having to hire competent maintenance staff is very challenging. When you can find those people, they're beginning to get extremely expensive. Is it the same mindset there, where you're trying to overpay so you can really develop a great staff so you don't have to worry about that heavy turnover?
It is, although we have actually found more success with maintenance and using contractors um, than actual maintenance staff, uh, especially in some of the more stabilized properties. Um, we just found that there hasn't been as much of a need for full time maintenance on the under 100 unit assets. So that's where the hiring a contractor that can take care of your maintenance it's really been the most efficient way for us so far.
No, that's awesome. If I was to ask you, here we are in an interesting time. Interest rates are going up. I was on a Zoom call the other night where there was a banker as the speaker, and I've just done some deals where I'm paying 3.5% interest. He's starting to say underwrite at 5%. And I think the template for a lot of us here is doing the value add deals, race to refi, see if we can get our investments back, turn that cash flow infinite. What is your take on that? Where do you think things will be in a year or so? Based on our template and how that may be affected.
Yeah, I mean, obviously rates are going up. Yeah, we're getting quotes in the high, mid high fours, even five in some cases, depending on the debt. So yeah, it's definitely here. I mean, rates have gone up, like you said, almost a whole over 1% in the last this year, basically. So um, we still are really, I'm still a believer that with inflation the way inflation is out of control, rents are still going up. So even if rates are at five and rents, on a national average are in the double digits increasing, I think there's still opportunities out there. Um, I'm optimistic that there's going to be a bit of a softening in the market, with some sellers thinking that maybe it's the top, so they want to unload, and then just fewer buyers. There's going to be fear in the market on the buy side, so there's going to be fewer buyers. That's what I'm optimistic about. Obviously, we keep an eye on it every week on what's going on, so it could change tomorrow, or this is Friday, so it could change Monday very quickly.
Absolutely. The rates are going to keep going up, but rent won't go down. Are you underwriting with an expanding cap rate?
Yes, absolutely. On all deals, expanding cap rate. It's a little bit market by market on how much we have it expanding, but yeah, every deal and increased interest. Like if it's a refi, we have a increased interest rate and an expanding cap
You know,
rate.
if I know Sharpline, you guys are buying in areas where the demographics check your boxes. So you're going to have that population growth, that job growth, ultimately that rental growth. Buy right, get the value add deals, make sure that you're buying where you're insulated from any of these market uncertainties. And it's the way to do it. You know, don't do it's a hot market, buy a stabilized asset at a 4.5 cap at this point in the market cycle.
Yeah, yeah. I mean, I right now I think debt is more important than it's been in a long time. If you, that's why we're big believers in getting long term fixed right now because we do feel like we are starting to we're getting close to the top of the market. Maybe we're there, maybe we're not. I mean, we'll know in like 5 years, but but if you have long term fix and you're cash flowing, then you'll be able to ride it out.
Yeah, and we're keeping our eye on that supply, that the inventory of apartments as we've all watched. I've been able to remain bullish when there's such a shortage of housing, so it makes you feel like it's still a good time to buy in the right spots as long as that supply and demand is still lopsided. Joe, this is the collecting real estate show. So they say you have to have three of something to make a collection. So we've got three questions for you to finish up. In 5 words or less, what's the most important thing you've learned since you started collecting real estate? That could be more than 5 words, just run with it.
Surround yourself with great
Bam.
people.
That's a
Number
good one.
two. Yeah, that's fantastic. Number two, what's your 1 to 2 year personal goals?
Yeah, I want to have 100 million in assets under management.
Steven always jumps in at this
I,
point.
I have to cut everyone off. We're talking personal goals. What does Joe Sullivan do on the weekends?
Yes, yes. Personal goals. So we're going to go on a family Disney trip by the end of the year. I've committed to that to my kids. I have 4 kids. I have 4 girls under 10 and under. So that's a
Fun.
big one. And then I want to lose about 10 pounds. That's a personal goal. And then I have a goal of reading 10 pages a day out of books. So I don't have like a number of books goal because each book's different. But I read every morning and journal every morning, and that's my. So I have some more. I'm a really big vision board and goal setter. Most of them are real estate related, but I do have some of those sprinkled
Those are
in
good
too.
Cool.
personal goals.
It sounds like you're working that miracle morning, which is, fantastic how to start your day. Lastly, how can Steve and I or the listeners assist you, and how do we contact you?
I mean, you can assist me by if you want to reach out and network, that'd be great. I love networking and meeting new people. You can reach me at joe@sharplineequity.com. Yeah, so I'm always interested in meeting new people who either could be a colleague, investor, or have a deal, or any way I can help them too.
Oh, that's awesome, Joe. Fantastic discussion. I'm looking forward to seeing the pictures of that property which had the mansard's roof instead of just seeing that finished rendering. I'm dying to see that finished product in real life because I think it's gonna look like a brand new property. So I'm looking forward to that. I know that'll work out great for you guys. Thank you for being on the show, and have a nice Easter.